Can you buy real estate as a group? Absolutely. But whether you co-own with an LLC, a partnership, or a syndication, it changes everything about your liability, taxes, as well as exit options. So let's break it down. Buying a real estate involves, as a group, uh, pooling money, resources to purchase a property. So first, make sure you have a clear mission or you understand what you're doing. Establish a legal entity like an LLC or a formal co-ownership agreement where you detail your financial contributions. But more importantly, make sure you have a very clear exit strategy. So what are the approaches to group buying? Depending on your group's goal, there are two primary methods to structure a group real estate purchase. First one is co-buying, which is living in or owning together. This refers to purchasing a property to share as a residence or as a shared investment. You can hold title in two different ways. One is joint tenancy, where if one owner passes, their share automatically transfers to the surviving co-owner. Then you have tenancy in common. In that, owner holds a specific percentage of the property which do not have to be equal. Second is group investing. So if you are buying property purely for investment, such as flipping, renting, or commercial development, you don't necessarily need to be on a standard residential mortgage. There are some hard money lenders as well. Real estate investment groups are often organized as partnerships or LLCs, and the members pool money to purchase property, and then there is a dedicated management company that handles daily operations and maintenance, which you don't want to take on. Then you have syndications, where a lead sponsor manages the project while massive investors, they pool capital, usually in exchange for equity, cash flow, and tax write-offs. The crucial legal and financial steps. So before entering into real estate with friends, family, or business partners, make sure that it's clearly spelled out and you have a formal documentation. So make sure you form an LLC. Many groups form limited liability company or LLC to buy property. It protects your personal assets from property related liabilities, and it separates your personal finances from the investment. You make sure you draft an operating agreement. This is probably the most critical document. It should clearly define each person's financial contribution, how expenses and profits are to be split, who makes key decisions, and how the voting works. Then you prepare an exit strategy. This often people overlook that. Life circumstances changes, partners may want to cash out earlier than others that you would not have thought of before. So your legal document should outline how the buyouts will be handled, how the share will be valued, and state what happens if the property must be forced into sale. Then you choose how you borrow. So lenders will evaluate the credit and income of all the borrowers. So you can apply for a single joint mortgage, or in some cases, you can utilize specialized platforms that allow individuals to hold separate loans tied to the same property as well. This is Salil Prasad. I'm a realtor based in Bay Area. I'm an active investor, so feel free to reach out to me should you need any guidance. Thank you so much.